Good evening. This is the Angry Capitalist Podcast. In today's episode, I'm going to be covering some updates on the economy. Today is February 1st, so I'll be doing a review of the economy going back into January. The format of this episode will come in the following method. First, we're going to cover a series of different metrics that we've had come out. Then we'll go over a few upcoming events. And then after that, we'll go over a couple of different risks that the economy may be facing into the future. Before we get started, please note this is not financial advice or investment advice. This is strictly for educational and informational purposes only. Do your own due diligence and don't be a bitch. Getting right into it. We'll start with inflation. So for these metrics, when it comes to inflation, please keep in mind that what we're looking at are the numbers from December. We're looking, in fact, a month behind. So when we get the January inflation report, when we get that report that comes out in January, it's actually measuring for December. Headline inflation came in at 3.9%. And core inflation came in at 3.4%. With that being said, on January 30th through 31st, the Federal Reserve held their January meeting. During that meeting, they chose to hold interest rates. So the Fed funds rate is still being held at 5.25 to 5.5%. While thinking about the Federal Reserve when this meeting was taking place, I had two thoughts that came to my mind. The first is, how likely is it that the Fed is looking to get away from the so-called zero bound rate policy or the ultra low interest rate policy? Second, could the Fed, and I'm specifically thinking of Jerome Powell in this case, be looking to use this opportunity with having gotten interest rates back up into the 5% range to try and enforce fiscal responsibility on the government? The government does have to go ahead and pay their debts, and if they want to raise new debt, they'll have to pay more for it. This could be the Fed effectively trying to rein in the federal government's rampant spending that they've been doing over the past few decades. Next, we're looking at layoffs and various jobs data. To start, in January, we had 82,300 employees get laid off. These employees were in the following sectors. As you may be very well guessing, tech is the big one. Insurance, banking, hospitality, and logistics. When I say logistics, I'm referring to like UPS and Amazon, had the largest layoffs. We have also had some bleed over into the manufacturing space. Auto manufacturers, I'm looking at you specifically. With the layoffs, we're going to unemployment rate. So the unemployment rate in January ticked up to 3.8%. With this number, please keep in mind that we have had higher revisions for over 12 months now, so take this number with a grain of salt. In fact, all states except Texas have been having increasing unemployment. Jobs. So during that same time period when we lost those jobs, we did have 107,000 new jobs be occupied. Additionally, with the jobs data, we have had downward revisions for over 12 months. So once again, take this with a grain of salt. More than likely, that jobs number will be downgraded. Additionally, you may be familiar with this. There is the possibility that some of that is due to what is called double counting. So effectively, if an individual takes on a part-time job along with their main job, or if they have to pick up two part-time jobs to make ends meet, they won't be counted as one employee with two jobs or one employee being employed. It'll count as two jobs for that bit of data. We have, in fact, back in 08, seen jobs creation increase due to that very reason. So take the number of jobs being created with a grain of salt. Additionally, there was something that was brought to my attention. This was from the Daily Feather Substack, produced by QI Research and Danielle DiMartino Booth, as I know her, the queen of monetary theory. Going back in 2023, during that year, approximately 80% of the jobs that were created were the result of the welfare state, not productivity or production. When I say the welfare state, what I mean is these were mostly like social workers, home health aides, retirement care aides, as well as administrators. So social workers and boomer care aides, effectively. This is a little bit alarming just because if 80% of the new jobs being produced are for that reason, that's not an indicator of economic activity. In fact, if we take away some of those jobs that are being created in part due to the welfare state, we may have actually seen a net negative number of jobs back in 2023. So keep that in mind. Next, going into upcoming events. So March is the month. First off, in March, we do have another Fed meeting. During that meeting, they may choose to raise, lower, or hold the interest rates. I don't know what they're going to do. They don't even really know what they're going to do until we get to that point in time. In March, we do also have something coming up. So during that month, as you may have heard it, various companies that are having to refinance their debt. Starting in March, a lot of the debt that is going to have to be refinanced will be hitting their balance sheets. What I mean by that is that they're going to go ahead and take the cost associated with having to pay something for that debt, factor that into their balance sheets. That may expose some zombie companies, but the main point of concern with that upcoming event is that that's going to be reported on their balance sheets for public companies on the stock exchange. Those companies are going to have to respond in some fashion that may be in the form of more layoffs to cut costs and to do other cost-cutting measures, perhaps reducing real estate that they are currently occupying as well, which could also continue to affect the commercial mortgage-backed security situation. Additionally, in March, we have the closeout or potential closeout of the Bank Term Funding Program. If you're not familiar with that, what that effectively is that back in 2023, June, if I remember correctly, we had a little bit of a banking crisis. And to respond to that, the Federal Reserve came out with the Bank Term Funding Program, in which they offered to buy or hold on to various banks' assets at book value, even if those assets had fallen below book value, and provide liquidity to the banking sector. That managed to mostly stop the bleeding within the banking sector. Depending on how that situation in March with the BTFP gets handled, we may start to see that increase the weakness in the banking sector. It could lead to more failures, or the Federal Reserve may extend that program, or maybe they have some other form of more long-term fix in place. Once again, that's something to keep an eye out for. Next, looking at risks. So going forward, I think we're likely to see more layoffs increase overall. Various companies are going to cost-cutting measures. It is what it is. One of the other biggest risks that I'm seeing out there is overall weakness in the banking sector. This comes from a few different points that are kind of combining together. We have, as consumer savings decrease, so too do the deposits that banks hold. Banks are underwriting fewer new loans. They're also starting to take the hit for various credit losses, and charge-offs are increasing. Effectively, what that is that banks have held on to various loans that were non-performing, meaning that they were not being paid out on loans that they were owed, and they just kept kicking the can down the road. Well, they're starting to go ahead and charge off those loans as bad debts. As banks have to go through these various measures to shore themselves up, they will also likely, not saying this is certainty, but they will likely have to increase their lending strictness. So that could come in a few different forms. Tighter lending standards when it comes to writing mortgages, business loans, personal loans, etc. They also may go ahead and just automatically decrease the available credit to consumers who are not currently maxed out. Please note, I'm not saying to go out and max your credit card. That is just something that may occur. When we combine that with the closing of the BTFP, once again, that's the Bank Term Funding Program in March, we may see a rekindling of a banking crisis take place. This next point was also brought to my attention via Daniel DiMartino Booth with QI Research and the Daily Feather Substack. Currently, we have the stock market going to all-time new highs. Mostly that is being done by the top 7 stocks within the stock market, most of which are tech stocks, multiple of which are not exactly profitable. What is driving that increase? A good deal of what is driving the increase of the top stocks in the stock market is index investing from 401k deposits. So for various individuals who have the means and resources to invest in a 401k, they're paying into it and they're getting an employer contribution. Those 401ks are typically just tracking the index. So they track the top 7 stocks in the stock market, and that'll go ahead and fuel those stocks' growth. The point of risk here is that if we start to see more layoffs, particularly in the upper middle class of the U.S. economy, those people who had these 401k accounts, if they need to, they may go ahead and make emergency withdrawals out of those 401ks, which could result in a pullback of the stock market. So it's a potential risk. I was not aware of this before checking that bit of information out, so I'm glad to have it. The next 2 points go a little bit further out there as far as risk factors that I see. The first is referring back to what I was saying earlier. The Federal Reserve may no longer be complicit with zero to near zero interest rate policy. Whatever the reasons may be with that, if that is indeed the case, we may have to go ahead and see the U.S. economy effectively restructure itself from the way that it's been operating for the past several decades. Goodness gracious, businesses may actually have to be profitable. Who would have thought? Next, with China. If you're not already familiar, they're facing a bit of an economic collapse. It's going about as well as you could expect a tofu building falling on your head would be. Fundamentally, it's being driven by a few different components. The first of which is their demographic trend. China has terminal demographics. They don't have enough young people to drive consumption. Next, most of China's growth previously was due to a massive build out in the Chinese infrastructure. Everything from condominium buildings to various boondoggles were overbuilt, rushed, and in many cases built very poorly. Because that massive build out was already done, and they've effectively overbuilt for what their needs are, their economy's effectively just falling apart. Next, we do have most of Europe in recession. So with Europe being in recession and with the potential collapse of the Chinese economy, we may have some risk of, as of yet, at least to my knowledge, unobserved contagion, which could spread to the US economy and have various impacts that we may not see coming. This concludes my report at this point in time. If you enjoyed this video, please do go ahead and like it if you haven't already. Additionally, if you have anything that you would like covered in more detail or anything that you have questions on, please go ahead and drop that down in the comments below. I would love to hear from you. Also, if you haven't already done so, please remember to subscribe and ring the bell so you get notified on further video updates like this. For those of you listening on Spotify, please do go ahead and follow the podcast. Until then, thank you. Take care. Have a good evening. Stay